Good morning everyone, we're Group 6. Today, we will discuss de-dollarization and the 2025 US dollar depreciation. In 2025, the international financial environment experienced notable changes. One striking feature was that US dollar weakened while US treasury prices increased at the same time. This phenomenon was not accidental, but occurred against the backdrop of an increasing tense geopolitical landscape, recurring acceleration of trade wars, and a marked increase in the global economic uncertainty. Such uncertainty encouraged countries and market participants to reassess their reliance on the dollar-based system, contributing to the gradual emergence of de-dollarization. Against this backdrop, weakening economic momentum in the United States led the Federal Reserve to cut interest rates 3 times in September, October, and December of 2025, lowering the target federal funds rate from 4.25 to 4.50%, down to 3.50 to 3.75%. As monetary policy shifted toward accommodation, the interest rate advantage of dollar assets declined, contributing to further depreciation of the US dollar. At the same time, US Treasury markets responded positively, with bond prices rising steadily. For example, a broad US Treasury bond price index increased from 108.59 in January 1, 2025 to 112.44 by 31st of December. In this context, our study applies the portfolio balance approach and internal balance frameworks to analyze the relationship between dollar depreciation and changes in US Treasury prices in 2025 and to assess potential future trends in the role of US dollar. Overall, this study helps improve our understanding of asset allocation behavior under de-dollarization and offers insights into the evolving role of the US dollar in the global monetary system.
For this part, I will briefly explain the theory behind the US dollar movement. First, based on the portfolio balance approach, exchange rates are influenced not only by interest rates, but also by how investors allocate their assets and how much risk they are willing to take. As de-dollarization continues, global demand for US dollar assets gradually declines. However, during periods of uncertainty, investors still prefer safe assets like US Treasury bonds. Second, regarding Federal Reserve policy, the Fed mainly focuses on internal balance, which means employment and price stability. Because the US has high capital mobility, it allows the exchange rate to float rather than targeting dollar stability. Third, according to uncovered interest parity and our shooting theory, expectations of future interest rate cuts can cause the dollar to depreciate in the short run. This depreciation may be larger at the first before the exchange rate slowly returns to its long-run level. Overall, changes in the US dollar are driven by policy choice, market exceptions, and portfolio adjustment, not by a sudden loss of confidence.
Now let's look at section 3, where we analyze the empirical evidence of the 2025 market anomaly through 3 key dimensions: price call movement, policy shifts, and structural trends. First, we observe the top graph. In 2025, we saw a striking divergence. The US dollar index fell by 4.3%, while the 10-year Treasury price rose by 4.1%. Traditionally, these move together, but this anomaly suggests that even as the dollar weakened, investors still sought treasuries as a growth risk or recession hedge. Next, the middle graph explains the driver behind this. To prioritize internal economic stability and prevent recession, the Federal Reserve adopted a monetary easing stance. Specifically, the Fed cut rates 3 times in late 2025, in September, October, and December, for a total reduction of 75 basis points. This reduction in interest differentials, combined with market expectations of overshooting, directly fuels the rapid depreciation of the dollar. Finally, the bottom graph provides a long-term context of de-dollarization. The share of the US dollar in global foreign exchange reserves has seen a steady structural decline, dropping from about 71 in 1999 to 57 range by 2025. This confirms that while the dollar remains the leading reserve currency, there is an active and gradual diversification into non-USD assets. In summary, these findings demonstrate that the 2025 dollar depreciation was not a random crash, but a combination of cyclical policy choices and a long-term structural shift in the global monetary system.
Hi everyone, I'm Gozi. Now I would like to briefly discuss why the US dollar depreciated while US Treasury prices increased in 2025. At first glance, this outcome may seem contradictory. However, it reflects on fundamental change in US policy constraints and global capital allocation, rather than a market inconsistency. In earlier decades, the United States could defend the dollar by raising interest rates and attracting capital inflows. By 2025, this strategy had become unsustainable. Prolonged high interest rates were placing pressure on economic growth, increasing the government's debt servicing burden, and raising financial stability concerns. Under these conditions, U.S. policymakers could no longer prioritize exchange rate stability over domestic economic stability. As a result, the Federal Reserve shifted toward monetary easing to reduce recession risks and stabilize financial markets. Lower interest rates reduce the attractiveness of dollar-denominated liquid assets, encouraging investors to rebalance their portfolios away from the dollar. This reallocation weakened the dollar. At the same time, dollar depreciation improved U.S. export competitiveness and helped offset weak domestic demand, making exchange rate adjustment part of the stabilization process rather than a policy failure. Importantly, the weaker dollar didn't lead to capital flight from the United States. Instead, global investors reallocated within U.S. assets. Despite declining confidence in the dollar as a store of value, U.S. Treasuries remain the world's safest and most liquid sovereign assets. Falling interest rates and strong safe asset demand therefore pushed Treasury prices higher, even as the dollar depreciated. These effects were reinforced by expectation of continued dollar weakness, which accelerated short-term capital outflows and amplified exchange rate movement at a deeper level. This episode signals a structural shift in the role of the dollar. U.S. monetary policy is increasingly focused on domestic objectives such as growth and financial stability, while the exchange rate is allowed to adjust through market forces.
To wrap up our presentation, let's look at the big picture of what happened in 2025. We've seen a situation that the US dollar lost its value, but at the same time, gold and US bond price went up. Why did this happen? First, using the internal versus external balance theory, we found that the Federal Reserve had to make a tough choice. Because of the recession risk and the massive debt in US, they prioritized the internal balance, meaning they chose to save their own economy by cutting interest rate, even though they knew it would make the dollar crash. Second, based on the portfolio balance approach, we see a major shift in how the world thinks. People are moving away from the dollar as a trading tool. This is the de-dollarization part, but they still bought US bonds and gold because they needed a safe place to hide during the global economic slowdown. In short, 2025 marks the US dollar itself is losing its status as a sole global anchor, while its underlying assets still return liquidity premiums in time of crisis. So, what are our recommendations? For governments and central banks, the era of only holding dollars is over. We suggest that countries, especially emerging markets like Malaysia, should speed up reserve diversification. This means holding more gold and regional currencies to protect themselves from dollar volatility. Also, promoting local currency transactions for trade will help reduce the pass-through effect of a falling dollar on our local inflation. For industry and firms, exchange rate risk is very real in 2025. Companies must use financial derivatives like forwards and options to lock in their costs. Don't just wait for the dollar to recover. Hedge your risks early. Finally, for the general public, we need to realize that the purchasing power of the dollar is going down. In a world with negative real interest rate, diversifying personal saving into hard assets like gold is a smart way to protect your wealth. To conclude, 2025 was a turning point. The financial world is becoming more multipolar, and we all need to adapt to this new reality. Thank you for your attention.